Good afternoon, everyone. We'll go ahead and get started. Thank you for joining today's investor update for Hela Apparel Holdings, covering our recently published earnings release for the second quarter. My name is Adam Collins, General Manager of Corporate Affairs and Investor Relations for Hela. I'm also joined by our Group CEO, Devanka Dinadasa, General Manager of Treasury, Navoja Premaratna, and my colleague from our Corporate Finance team, Shannon Gomez. To outline the agenda for today's call, we will start with a presentation of around 50 minutes that will cover our Q2 results and an update on the outlook for the coming quarters. As with the past few quarters, we will start with a few slides providing an overview of the group's consolidated performance for the quarter before moving on to discussing the two business divisions separately, starting with the private label manufacturing division before moving on to the brand licensing division. We will then sum up with a few slides on the group outlook. And as always, we've included some slides on our social capital initiatives. We won't be presenting these, but we would encourage you to refer to these as we will be sending the deck out by email after the call. We will also be making the recording available on our YouTube page as usual for any colleagues who were not able to join today. Following the presentation, we will move on to a Q&A session for the remainder of the call. Questions can be shared through the Q&A box on your screen, and we would encourage you to send your questions in as we go through the call, and then we'll take those up at the end. A final quick word before we jump into the presentation, and a disclaimer on forward-looking statements. Any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainties that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place sole reliance on them. We also do not undertake any obligation to update these statements to reflect future events or circumstances that may arise. And with that, I will move into the body of the presentation. So starting with the group outlook. This slide gives a summary of the group's consolidated results for the second quarter. The headline takeaway for the quarter is that while there's still work to do, we have demonstrated a significant improvement in our financial performance that we believe very much validates the significant steps we've taken over the past 18 to 24 months to realign the business to a more agile footing. So starting with revenue, we saw a significant increase of 36.5% year on year, and abstracting from the rupee-dollar exchange rate movements, this increase in US dollar terms was 44%, or just over 44%. And while this is largely reflecting the addition of the brand licensing division after the acquisition of Focus Brands in January, we are also seeing a steady recovery in demand for the private label manufacturing division as well, which I'll touch on in a subsequent slide. The second major aspect to draw your attention to is the gross margin on the bottom left. So this has doubled on both a quarter-on-quarter and a year-on-year basis to just over 19%. And this is the highest gross margin Hela has reported for 14 quarters. That is almost 4 years. And this also isn't just about the addition of the brand licensing division. This also reflects a very significant improvement in the gross profit margin of the manufacturing division as well, which I will also touch on a little bit later. And as a result of this, as you can see in the middle, and as well as prudent management of our admin and distribution costs, we have seen a significant improvement in our operating profit and a return to operating profit for the first time in 8 quarters. So in short, this is the first operating profit we've recorded since the significant drop in demand that hit the entire industry began in the FY 22-23 year, in the second half of that year, and marks a significant turnaround in our performance since this period. That said, we remain conscious that we have further work to do on improving profitability, and as a result of our finance costs, we recorded a post-tax loss of about 500 million rupees. Albeit the smallest net loss in 8 quarters, we are very conscious that there is room for further improvement to drive that back to profitability. In addition, we are also, as many of you will know, engaged in an overall capital augmentation strategy to strengthen our balance sheet. And so our rights issue was completed just after the end of the quarter. And taking that into account, our net debt to equity ratio was 3 as of the end of Q2. So more or less stable, or slightly down actually from the year prior. So that also ensuring that in this context of an improving financial performance and top line growth, that we have the balance sheet to support it. Moving on to a snapshot of the divisional performance. So this is to put some additional context on the overall group performance. The table I'm showing at the top shows the group performance in the second quarter of this financial year with the comparison to the second quarter performance of last year. And then the equivalent for the private label manufacturing division and the brand licensing division on the right, of course, with no comparative because that was for 2023, because that was prior to the acquisition. Two additional points I want to draw your attention to on this. So as you can see, if you look at the revenue line, there was a 6% decline in year-on-year in the manufacturing division's revenue. However, this was primarily due to the appreciation of the rupee against the dollar during that period. So on a dollar terms, revenue was about flat, and on a quarter-on-quarter basis for the manufacturing division, it grew by over 8%. So that is showing a steady recovery there as well. In addition, the other aspect I would draw your attention to is, as I mentioned on the previous slide, the significant improvement in the manufacturing division's gross profit margin, which you can see in the middle of that. So that has went from 8.2% a year ago to over 16% as of Q2 of this year. And that is also versus 10% in Q1. Right? So a very significant improvement on a year-on-year and a quarter-on-quarter basis. And this is also the highest gross margin that the group and this division in itself has recorded in 14 quarters as well. So a very significant improvement being driven on that side as well. So to put this overall performance in further context, these two charts kind of set it out. This on the left, I'm showing the group revenue over the past 3.5 years on a quarterly basis, and on the right is operating profit. Starting on the left with group revenue, the dark blue bars are showing the manufacturing division's revenue, with then the addition of the brand licensing division starting from Q4 of last year in the light blue. And so what you can see is there's very much been a stabilization and a gradual growth in the manufacturing division's revenue from that low point you can see there in Q3 of last year. And then with the additional fillip coming from the addition of the brand licensing division as well on top of that. And then turning to operating profit, which is also showing the operating profit for the manufacturing and the brand licensing division separately from Q4 onwards. You can see in the dark blue bars that in a very marked improvement in the profitability of the manufacturing division from about Q4 last year through to its first material operating profit since the middle of 22-23, and then the additional profitability coming in from the brand licensing division as well to support that through. So really in this context, you can see the overall picture is of an improving revenue base and a significant swing back to profitability at the operating profit level as well. One final slide from the group picture is to summarize the kind of closure of our rights issue. So, and just be clear about where that sits on the balance sheet. So the rights issue was to raise over just under 1.6 billion rupees, and that was successfully oversubscribed during the month of September. And so while the rights issue did close in the month of September, these shares were allocated only in early October. So for the purpose of the Q2 balance sheet, the rights issue proceeds were recorded under liabilities rather than under equity. But that will be more of a timing issue, and you will see that increase in stated capital coming in Q3. As of 18th November, the proceeds have also been fully utilized, which was for the stated use as given in the shareholder circular for the settlement of existing bank borrowings. So you will also see that impact coming in as well in the Q3 balance sheet. And just to reiterate that we very much see this rights issue as representing the first phase of a wider capital augmentation strategy to strengthen our balance sheet. And so we would expect details of subsequent raises to be announced in due course as they are determined by the board of directors as well. So that closes the section on the group outlook. I'm now going to take a couple of slides specifically on the private label manufacturing division and its performance in the second quarter. So the table at the top here is showing the revenue and adjusted EBITDA performance Q2 of this year versus the previous year. And I will come back to the reason for the adjustment. So as I mentioned, that revenue dip year on year that you see was primarily due to the appreciation of the rupee. In dollar terms, it was flat, and we are seeing that kind of gradual recovery in demand from key brand partners on a Q&Q basis. So it was up up just under 8% in US dollar terms, Q&Q, in the second quarter, and was more than 20% from the low we recorded in terms of revenue in Q3 of last year, which you saw on the chart just a couple of slides ago, which makes it kind of in that context of a gradual top line recovery, that makes the improvement in profitability all the more dramatic and favorable. So as you can see, we've recorded a beta margin of just over 5%. So that is a very significant improvement of over 1,600 basis points. And it's worth also pointing out that while you will see on the face of our group P&L that admin costs and distribution costs have increased year on year, that is entirely due to the consolidation of the brand licensing division. If you take the manufacturing division separately on a year-on-year basis, both admin and distribution expenses have declined reasonably significantly as well. So that's also why you see that slightly larger increase in the EBITDA margin vis-a-vis the gross margin. And one final important point to mention for the manufacturing division, and the reason why the EBITDA is adjusted is because in the second quarter, we recorded some exceptional one-off costs of just under 270 million rupees related to the scaling down of the division's Ethiopian manufacturing operations. So to explain that in more detail, I've laid that out on this slide. So during the quarter, the manufacturing division took the strategic decision to scale down its manufacturing operations in Ethiopia. And that is due to the challenging operating location. That is due to the challenging operating conditions in this location. So most notably, Ethiopia lost its duty-free access to the US market in 2022. And in addition, over the past year, we've seen a significant increase in freight costs and disruption due to the restricted maritime freight in the Red Sea, which is the primary freight route for Ethiopia. So that has created significant challenges and increased significant costs. So the business took the strategic decision to scale down this operation for the time being. And that downsizing took effect as of September, including with a significant reduction in the number of employees. So the one-off costs, which we mentioned during Q2, were primarily related to those employee reduction costs. And the kind of key takeaway from a financial outlook perspective is that we're not expecting this decision to lead to any revenue or capacity constraints, given the flexibility we have across our other operating countries. So the existing order book that was being manufactured in Ethiopia has been transferred to Egypt and Kenya, where there is available capacity and the potential to scale further. As many of you will recall, we moved the Kenyan facility from a double shift operation to a single shift operation. So even with this move, we still, if we were to return to a double shift in Kenya, would have the ability to scale up capacity quite significantly further. In addition, excluding the one-off downsizing costs, we do expect this to have a net positive financial impact due to the overall reduction in group operating costs. And also because we'll be moving the orders that were manufactured in Ethiopia to locations which are duty-free to the US, there is also that opportunity for additional margin gains by offering that benefit to the customer and sharing it with them as well. So that is the status of Ethiopia and an important update from the manufacturing division as of Q2. Moving on to the brand licensing division. So again, similar table, revenue and EBITDA shown at the top. So the revenue of 7.3 billion rupees compared to 4.7 billion in Q1, so that's quite a significant jump. And that primarily reflects a strong seasonal pickup in demand. So the second quarter has historically been the BLD's strongest, or one of the BLD's strongest selling periods because of the timing of European fashion seasons. So that was largely expected, and it was in line with expectations. And that significant jump in revenue has also supported a robust EBITDA margin of just below 6%, and it's fed through to a profit before tax of 342 million rupees for the quarter as well. So the overall takeaway for the BLD is that it was a strong and positive second quarter in one of its key selling periods, and its performance continues to track in line with expectations and its previous year's performance as well. So really that objective of stabilizing the business post-acquisition is currently coming through in the results that we're seeing. The kind of additional upside from some of the other initiatives that we've been talking about over the last few quarters in terms of the new brand licenses, such as the Reebok outerwear license, there also is a distribution channel strategy kind of drive improved gross margins. Those you will see coming through a bit more strongly towards the next financial year. Currently, we're expecting an overall profitable full year for the brand licensing division. It's very much in line with expectations, but with a lot of further upside in the coming financial year as well. And to add some kind of further color to the developments in the brand licensing division, two major points for the quarter. The first one is that they will be opening their first LS outlet store in the UK just in the next couple of weeks. So this will represent the BLD's first physical direct-to-consumer channel for LS in particular. And the picture on the right-hand side is actually a picture of the store that will be opening in the next couple of weeks. And this is an opportunity to monetize some of the existing inventory that we have for LS, as well as build out that direct-to-consumer channel as an additional distribution channel for the group. There's also, potential opportunity and synergy with the manufacturing division to use some of the excess fabrics that can arise from a manufacturing business through a kind of channel like this, and also drive additional cash generation. In addition, there has been some significant movements in terms of repositioning and relaunching the LS brand, which is one of the most important for the BLD. So there was a major brand relaunch that took place in Italy with the brand owner Pentland Brands during late October, and that is very much positioning the BLD as one of the lead licensees for LS globally as well. So we see this as a sort of very much a strengthening of the relationship between the BLD and the brand owner in terms of taking this brand forward strategically. Focus Brands also held its own launch event in early November as well for its retail partners. So this is part of an overall broader strategy for LS to elevate the brand and take it into some higher margin outlets. And so this will also be supportive of an overall divisional strategy to improve the gross margin by shifting the distribution channel composition as well. So that is two kind of major takeaways from the quarter for the brand licensing division. Finally, to close on a couple of slides in relation to the group outlook. Starting on the operating environment. So really the overall takeaway here is that it is a fairly benign and stable operating environment, but with some significant risks factors on the horizon as well. So consumer demand conditions and through our customers is currently relatively stable. So you will see a mixed picture across the fashion sector. You do have some fashion brands which are doing less well and others which are doing much better. I think you will see that translate into Hela's results by the fact that we have a more diversified customer base in the past. So that is overall what's supporting revenue upside for us. And then also we have interest rates coming down in major economies, which will be supportive of consumer demand conditions, and also reduced finance costs for us as a group. However, kind of the major development of the quarter being the US election results does present additional uncertainty, and we will of course be watching those policy developments very carefully. Though I think we would highlight that there may also be opportunities in that as well. It is worth pointing out that it was the previous Trump administration that was negotiating a free trade agreement with Kenya. So we will be watching closely to see as those policy developments occur. But we do see some opportunities on that front. Moving on to the specific outlook for both of the divisions, starting with the private label manufacturing division. So the current order book would indicate a further year-on-year revenue pickup in Q3, further gradual year-on-year revenue pickup in Q3. But beyond that, the outlook for Q4 is more pointing towards a stabilization in demand rather than further material growth. It is a little bit early to say strongly on Q4, but that is currently what we are seeing. So that'll be the context in which we're looking to position the business in. For the brand licensing division, it's important to flag that from a seasonal perspective, Q3 is expected to be softer than Q2. And that would be, again, in line with historical trends because of the way the key fashion seasons fall. But overall, the picture for BLD is it continues to trade in line with our expectations and is on track for a profitable full year as well. So in this context, and a final slide of takeaways, we very much remain focused on profit margin improvement to drive a sustainable return to net profit over the coming quarters. So the positive Q2 results have demonstrated the impact of the significant restructuring measures we've taken over the past 18 months. And really, we are seeing them as demonstrating the validity of those, and we expect to see further improvement based off those. But we do appreciate that there is further work to be done and the focus on driving profit margins higher. Two major focuses for this. The first is ensuring agility of the manufacturing base and tightly controlling its cost base. So in the context of a demand environment which is gradually improving, but where it seems to not be indicating a very strong increase in demand beyond Q4, we'll be looking to position our manufacturing footprint agilely so that we have the flexibility to scale up and down and ensure that profitability is maintained even in an uncertain demand environment. We will also be continuing to focus on overall tightly controlling operating costs, with a continued focus on identifying cost efficiencies and potential cost opportunities to remove cost duplication as well, to ensure that as we drive that further improvement in gross margins, that pushes through down to net profit as well. And then the additional focus will be on continuing to drive the upside potential of the brand licensing division and its synergies with the manufacturing division as well. So as I said, BLD will continue to be impacted by seasonality in the short term, with Q2 and Q4 of our financial year being its strongest selling quarters. But the division very much remains on track for a profitable full year, and we expect it to add profitably to the group for the full year. And really, where you'll see the impact of the current initiatives, including in terms of reducing some of that seasonality and ensuring that as much as possible all of the quarters are profitable, you'll start to see those drive greater revenue and margin growth as we move into the next financial year, so 25-26. And so that will help to drive that, as we start to also see some of the benefit of some of the synergies we've been building in terms of the brands which we've introduced to Tesco, which we're manufacturing for, the potential opportunities to continue to build the manufacturing relationship between the PLMD and the BLD as well. So those will also be helping to drive additional margin growth. So this will be the focus for the coming quarters. So that brings me to the close of the presentation part of the session. And we'll now move to the Q&A. And please do feel free to send in your questions. I believe we already have a number of questions, so we'll just scan through those. So if we take the first one, there's a question on a Nike agreement on brand licensing, which I think, Duncan, I can leave that to you.
Sure. I think that might be a misunderstanding. There is no association with Nike on the brand licensing side. We manufacture for Nike, and Nike's licensees from our manufacturing division. We produce some Nike underwear and outerwear jackets, but we don't have any licensing agreements with them.
Yeah, I think where there may be potential for further upside is on the Reebok outerwear license. So that is because it's a relatively new license still being built out, but we'll see, I think, a greater impact from that. Yes. And potential synergies with the manufacturing division in terms of manufacturing orders coming in the next financial year.
That's right.
Okay, there's a question on the current operating conditions in Egypt in terms of logistics, tariffs, and efficiency. I'll give that to Duncan.
Of course, it's been challenging ever since the Red Sea situation came into play. So when shipping raw materials from the Indian subcontinent, there is additional lead time and freight costs that we incur, which is all the more reason that we need to source more and more from Egypt, and that's a transition which we've driven. And today's news of some of the leading fabric manufacturers from Sri Lanka coming and setting up in Egypt, all this will definitely help us in our localization drive. In terms of efficiency and tariffs, Egypt's got very favorable tariffs both to UK and Europe, as well as the US. There's been no indication of that changing, and especially the one to the US is not time bound, or it's indefinite. So we don't see any major challenges there, and efficiency continues to maintain status quo. It's quite competitive.
A related question on Egypt,
Yeah.
Which has just come in, is will there be any downsizing in the Egypt operations?
No, we don't see any rationale or reason to downsize. If at all, Egypt will be one of those country of origins in our portfolio that we will look to expand even in the future.
Yeah, and I think the kind of key point to mention there is that Egypt does not have the same kind of operating challenges that we faced in Ethiopia. It remains duty-free to the US and has some alternatives in terms of maritime freight as well. It obviously is impacted to some extent by the Red Sea issues. Yeah. Okay, moving on. The next question is, what drove the pickup in the PLMD's gross profit margin? Is this sustainable?
Yeah, so it's multiple reasons. The first one being capacity utilization. Naturally, as your capacity is fully utilized, your GP margin improves. We've also had better discipline, focusing on profitable customers, negotiating better prices both from our customers and from our suppliers, better utilization. And these were all focus efforts. If you look at our contribution margin, our average for the last year was around 34.5%. Last quarter, we finished close to 38%, just under 38%. So all these initiatives helped drive that contribution margin, and that kind of trickles down over to GP and then NP. So this will continue to be our focus for the foreseeable quarters as well. We would love to drive another 100 to 200 basis points in further margin improvements.
Sure. Thank you. The next question is on the debt to equity ratio post rights and post settlement of the debt. So Nivoja, if I can give you that one.
Yes, so the debt to equity that we presented in our first slide is adjusted for the rights issue. So it will be about 3 times.
Yeah, so
at group level. Yeah.
Yes, correct. So that's the net debt to equity ratio, which from our point of view is the most relevant for us. So post and taking into account the rights issue, it should be 3 times. A question in relation to capacity in the context of the downsizing of the Ethiopian operations. Perhaps, Don, you can add some kind of additional flavor on how that feeds into the overall capacity picture.
Sure. I mean, it's difficult to explain the capacity in pieces because the output in pieces can range depending on what type of product you're manufacturing, and it's never status quo when it comes to categories that you're producing, but it's purely based on demand. But from a standard hours perspective, which is the key metric that the industry uses, so we range between 600 to 650,000 standard hours. So even though Ethiopia was downsized, that was offset by expansions in Egypt, and there will be a bit more expansion happening in Kenya as well. We have been expanding Kenya over the last few months, and it'll continue to expand over the next 2 to 3 months as well. So it's really rationalizing. So we kind of moved it from Ethiopia over to Egypt and Kenya, so that we can get benefit on through the duty-free agreements that these countries have, and of course the favorable logistical conditions that these countries have when compared to Ethiopia.
A question kind of related to that on country of origin is, which country of origin do you see potential growth to come, considering the shift of business from Bangladesh?
Right now we are experiencing growth in Kenya and Egypt. What we are continuing to drive as part of our rationalization strategy is to consolidate our capacity in our factories, offices, teams, as part of our margin improvement initiatives and business sustainability. So we will see, I guess, to answer the question, I guess we will continue to see growth happening in both Egypt and Kenya for us.
Okay. A question on how the election of US President Trump will affect overall apparel exports from Sri Lanka and other countries to the US. So we touched on it a little bit on the presentation.
Yeah.
I think the kind of key takeaway is we have to see exactly how the policy measures turn out. as he comes into office. At the moment, some of the things that he's talked about would affect all countries, so would not necessarily disadvantage any of our sourcing countries in particular. But I think we do also view that we have, you know, a fairly good and agile manufacturing country of origin base, and that would be remain kind of favorable within a US context in terms of the overall sourcing picture as well. So we'll be watching it closely, but as of now, we don't see any immediate risks on that. So I think there's a couple of questions in relation to volume growth. I think to kind of put that in context, we would say that the revenue uptick was primarily driven by volume growth. Sort of no major price increases coming through there. So that's primarily what is driving that. There's a question, I guess, on the outlook for finance costs in the context also post rights issue. Navoju would be able to add a few comments on that.
Yes, so most of our debt, I believe, predominantly like 99% of our debt is on floating exchange rates. So definitely the decrease or like reduction in SOFR helps. But at the same time, what we see is an increase in revenue and also the working capital requirement as well with that growth. So that sort of offsets. So in the short term, we wouldn't see a reduction in finance costs simply because there's an increase in sales or like, you know, working capital requirement. But in the medium term and long term, finance cost as a percentage of sale, along with the operating sort of profits that we expect over the next couple of quarters, and also the capital augmentation strategy, it should probably reduce by 1.5%. If you take it as a percentage of sale.
Yeah, so it will be linked to kind of movements in US interest rates, and we have seen some kind of post the US election, some additional uncertainty on the exact path of US interest rates, but it is very much in a reduction direction, which will be supportive of that overall reduction in finance costs. So the couple of kind of questions to sum up on, I guess, cost headwinds. I think freight cost, exchange rate appreciation, and raw material prices. Have we seen kind of, how would you summarize the overall cost environment?
I mean, we've seen a slight reduction in freight costs from its highs. It's still a lot higher than what it was, you know, from a year-on-year perspective. The rupee appreciation, of course, as an exporter, does tend to have negative impacts, especially when you've got a large local rupee-based overhead. So in dollar terms, it does deplete margins. Raw materials also, we don't see an increase in raw material prices. I think it's fairly flat for the time being.
Yeah, so I think in the context of also, you know, rupee appreciation, still relatively elevated freight costs, that does also drive home that the improvement in the PLMD's and manufacturing division's profit margins has been despite all of that, despite those kind of cost headwinds. So if and when we see some of those factors ease, that will also be supportive of profitability as well. I think we've covered most of the questions that we've received. I guess just one final one to sum up. So will any possible escalation of Middle East or Russian-Ukraine conflicts, do you see any impacts in terms of demand and price pressures vis-a-vis cost impact on commodities, or I guess consumer demand as well?
It's difficult to say. I mean, one cost line item that can have an impact is freight costs. because we've seen that happen in the past. But what it would do to other commodities, including energy prices, it's hard to predict right now.
Yeah, so I think we are already in the context, right, where some of the cost factors such as freight are relatively elevated. So you could also see that going in both directions. So that is really in the overall context of a fairly benign operating environment right now, but with some potential significant uncertainties over how global conditions will evolve in the next coming quarters, which is really why we're kind of adopting that more agile footing, and we'll be continuing to focus on driving margin improvement. So as and when there's shifts in demand conditions and in global conditions, that we're suitably positioned for those. Yes, we'll do one final question on the seasonality of the brand licensing division. You mentioned that Q2 is seasonally the best. What is the worst quarter?
The first quarter has historically been the worst. In fact, prior to the acquisition, the first and the third have been equally bad. But post-acquisition, the team has done a pretty fantastic job to drive the third quarter to closer towards the positive bottom line, or build a business model that drives a positive bottom line in Q3 as well. The strongest quarters are Q2 and Q4. Q4 being the best quarter of the year. So something which the team is working on right now is to kind of even this revenue flow out over the next year, so that we can soften the hit that we normally face on the first quarter.
Yeah, so I think we've covered all the questions that we received. If we haven't had a chance to get to your question, please do feel free to drop us an email to the investor relations email address, and we will get back to you on those. But with that, it leaves me to say thank you very much for taking the time to join today. We will be sending out the presentation after the call, and please do feel free to get in touch with any queries you may have. And I wish you a good rest of your day. Thank you very much.